This is a presentation on the BCG Growth-Share Matrix, a portfolio analysis strategy. So as a brief overview of what we're going to be talking about today, we're going to begin with the history and the explanation, followed by the definition of market growth and market share. We're then going to talk about the definition of the four quadrants, followed by the strategies for each of these categories. Next, we're going to talk about the practical uses and advantages, and we're going to conclude with the limitations and disadvantages. Beginning with the history and explanation. The BCG matrix, also referred to as the Growth-Share Matrix, was created by Bruce Henderson in the mid-1970s for Boston Consulting Group. The BCG matrix is helpful in terms of portfolio examination and management decisions. However, the matrix was initially created to help various associations with the errand of investing their product offerings in their portfolios. At the pinnacle of the matrix success, which was during the late 1970s and early 1980s, about half of all Fortune 500 companies were utilizing the matrix to determine which markets and business units to invest in. This was based on two factors. The first factor was company competitiveness, and the second factor was market attractiveness. The drivers for these two factors, being relative, were market share and growth rate. The BCG matrix takes into account for the horizontal axis the relative market share, which is an indicator of the dimension of the business unit. Relative market share is calculated by dividing either the market share or the revenue of the strategic business unit by either the market share or the revenue of the biggest competitor of that business unit. The midpoint will be intuitively 1. This means that a number greater than 1, for example 1.1, indicates that the business unit is the biggest in its industry and it is also 10% bigger than the next competitor. It also indicates that the business unit will be placed in the quadrant corresponding to high for market share. The dimension of a business is strategically important because it indicates if there are economies of scale, hence lower cost, hence higher profitability. The vertical axis in the BCG matrix instead measures the market growth expressed as a percentage. It indicates the future outlook of the market. Inside the growth share matrix, the midpoint is usually set at 10%, but it can vary accordingly to what is considered significant inside each industry. In a high growth rate industry, the business unit will need to invest heavily in order to sustain or develop its competitive advantage. Because of the high level of investment, firms will need to charge higher prices in order to cover their high costs. At the time, there will be a high risk of new entrants looking to capture market share due to the attractive growth rate. On the contrary, a low market growth rate means that a business unit will usually need less investment and prices will be lower in order to gain as much market share as possible. Additionally, the risk of new entrants will be low due to either high capital requirements or low attractiveness. The first box of the BCG matrix is a dog, which consists of both low market growth and low market share. A dog should be avoided for they do not generate large amounts of cash for the business and they often only break even. Furthermore, it can often be very expensive to recover a dog and move it into another segment of the matrix. In general, it is often best to divest in the products or services in the dog segment rather than investing in them further. The next segment of the BCG matrix we are going to look at is the question mark. The question mark consists of high growth and low market share. A question mark often consumes a tremendous amount of cash but returns very little. Due to the high growth potential, however, a question mark has the ability to transition into a star, or on the flip side, it could transition into a dog. It is important to monitor a question mark carefully to determine whether or not to invest in them further. The third segment of the BCG matrix we're going to look at is the star. A star has both high market share and high market growth, and as a result, generates large amounts of revenue for the firm. Although stars are generating large amounts of revenue, they can also be very expensive, requiring large amounts of cash. Stars can become cash cows by waiting until the market growth rate declines. Therefore, companies are advised to invest heavily in their stars or hold them. The final segment of the BCG matrix is the cash cow. A cash cow consists of low growth and high market share. The benefit of a cash cow is they generate more cash than what they consume. Furthermore, a cash cow provides the capital to transition a question mark into stars, cover various costs such as administrative costs for a firm, pay dividends to the company's shareholders, or fund new research and development. Companies are advised to harvest their cash cows to reap the benefits they provide. The size of the individual icons represents the revenue generated by each segment. My colleague will now present on practical uses and advantages of the matrix.
Companies find the Growth-Share Matrix to be particularly useful in order to organize and strategize their portfolio. By mapping the different segments according to their revenues, relative market share, and industry growth rates, companies are able to better understand where their business has its strengths, weaknesses, and opportunities. By visually representing this, management is able to make decisions easier when mapping out a strategy to achieve their short and long-term goals. From a strictly operational standpoint, it provides a snapshot of the current positioning of its SBUs. For example, a company might use the Growth-Share Matrix in budget meetings to view where their cash is being generated and where it would be most effectively allocated. If performed correctly, the Growth-Share analysis will provide a clear picture of the firm's portfolio. While there are clearly a lot of benefits to using the BCG matrix, firms must be cautious to not solely rely on two criteria in their strategy decisions. Also, the matrix is only able to show the current position of the portfolio and might give insight into where the firm should invest money, but does not necessarily inform the firm of how much to invest in certain segments. At the same time, this analysis does not take into account the synergies that one dog segment may provide to the rest of the segments. In short, it provides a very simplistic framework for a very complex and analytical situation. It should be emphasized that the matrix is a starting point for decision making. Also important to note is that the matrix was developed for very large corporations who manage large portfolios which are otherwise hard to track. Small businesses, however, who operate only in one or two different segments would not find this matrix helpful due to the lack of deep analysis. Since developing a detailed and accurate matrix is quite research intensive and time consuming, a small to medium-sized company would have to weigh the costs and benefits of paying their employees or a consulting firm to properly develop the matrix. Since its inception and widespread use during the 1970s and 80s, one firm performed a study whose results revealed that companies who followed the matrix actually experienced a loss of profit. In response to this study, the Boston Consulting Group revised the model to include other factors, including the speed with which companies adapt to external environment changes. Here are the sources we used to develop this presentation. Thank you for watching.